In today's first ever virtual podcast, I had my friend Tim Bratz on the show. We're out here in Austin, Texas at his multifamily event right now. And for Tim, he is the multifamily expert. He's got over 4,800 units that he's accumulated in just the last 5 to 6 years. On top of that, we talk about a deal that's going to be worth over $100 million that he's doing. So you don't want to miss out. He even goes over how you can get started in multifamily today. It was an awesome interview. So let's jump in it.
Welcome to the Ryan Pineda Show, where our mission is to invest,
I only expect to make money in things that I understand.
innovate,
It's about believing in the future and thinking that the future will be better than the past.
and inspire.
I am much more likely to hit my goal just due to putting it out there.
You now rocking with the best.
What's going on, everybody? Welcome to another episode of the Ryan Pineda Show. Today, we have a virtual episode. This is actually our first ever virtual episode. And we've got my friend Tim Bratz, who I'm here at his legacy event out in Austin, Texas. And let me tell you guys, Tim is one of the biggest players in the commercial real estate space. This dude has 4,800 plus units. I think last time I talked to him, it was in the 2000s. So he bought like 2,000 out of nowhere at some point. So, dude, happy to be here with you again.
Dude, excited for you to be here, man. It's a huge honor to have you here and have you speaking at our event. And I was actually talking with some people offline about some of the speakers. Dude, it's we only have 4 headliners. You're one of them, Emmitt Smith, right? Like NFL all-time leading rusher, multi MVP, Pro Football Hall of Famer. You guys are speaking on the same day. We got Tucker Max, who's a 4-time New York Times bestselling author, and my good friend Christina Kraus, who you also know.
Yep.
Who's one of the biggest data and direct mail marketing wizards in the entire country. Like hedge funds, billion-dollar hedge funds, utilize her company in order to do all the direct mail. So it's and anyways, like we're talking about all the folks, and your name came up, and obviously, and everybody's like, dude, Pineda's a great guy, right? He delivers such amazing value. He's such a high quality, like a relatable person, authentic, genuine, and actually cares about the value. He's not one of these gurus on social media who's just kind of flashing stupid stuff. Like, you deliver super high quality content. I respect the hell out of you for that. So, dude, it's an honor to have you here.
Yeah, man, I appreciate that. Yeah, and when you told me Emmitt Smith and Tucker Max and all these guys are here, I'm like, man. And I'm the headline, like not the headliner, but I got
opening, bro.
I got an opener.
Yeah,
man. So that's a lot of pressure. So I got to deliver on that for sure.
I know you will.
But yeah, dude. For those of you, I guess for our audience who's unfamiliar with you, why don't you give them a brief backstory of how the heck did you get to 4,800 rental units?
Well, here's the thing, man. I am a blue-collar kid from Cleveland, Ohio, right? Like, my dad was a cop, my mom was a teacher, I went to public school, grew up in a B-class neighborhood, and, worked hard at school, was told to go to school, get good grades, you can get a good job, that whole story. And my dad was a full-time police officer, but he had this part-time business that was like personnel security that would help out with, essentially the personnel at a hotel or at a foundry or a factory or at a apartment building in Cleveland, Ohio. And he made more in his part-time business than he did in his full-time job. And, he's telling me to go to school, get a good grades, get a good job. And I'm like, but Dad, you're making 2-3 times as much money in your part-time business than you are in your full-time job. So I was at least aware enough that it didn't equate in my mind that I should go and get a good job. I was like, I want to be a business owner. And so early on, it was about the money, right? And so when I went to college, I tried finance, and then I went into marketing. And when I was in college, 03 to 07, the market was going crazy. Everybody's making money in real estate. And if you had a pulse, if you could fog a mirror, you could make a lot of money in real estate. And so that was what motivated a 20-year-old kid. And so when I graduated from college in 2007, I moved out to New York City. My brother was living out there, and I thought you got involved in real estate. I think like you did when you got a real estate license. And so I went and got my license, and I started brokering commercial real estate leases. So I'd either represent a business that wanted an office or a retail space, or I represented a landlord who was marketing their office or their retail space to a business. And I got the bottom of the barrel leads. I got like all the garbage on side streets in the rough parts of New York. And while I was going through that, it took me like 8 or 9 months to close my first deal. And on the first transaction I closed, which was a dumpy little 400 square foot space, kind of like the size of this, of this room that we're in right now, maybe a little bit bigger. We signed a lease on a 12-year term at $10,000 a month.
For a 400 square foot place.
For 400 square feet with 4% annual increases. And you start, as a 22-year-old, money-hungry kid, I started doing the math on this. I was, punching into the calculator. I'm like, this landlord offered this one space. And he had 8 retail spaces. This was one of them, the smallest one. And he had 15 stories of apartments above it. I'm like, this dude's going to make almost $2 million over the next 12 years for doing something once.
Yep.
And that's really when the idea of residual income resonated with me. And I was like, I'm on the wrong side of the coin. Instead of brokering real estate, I need to be owning real estate. And so, I'm 22 years old in New York City. I can't do anything there. At least I didn't think I could. And so I moved down to Charleston, South Carolina in 2008. In 2008, summer of 2008, I moved down to Charleston, and I'm just like learning everything, right? I'm trying to study real estate. I'm trying to learn about wholesaling. I'm plugging into all these different events and buying these courses and just studying everything. And I'm ready to go out and buy my first property, and all of a sudden, like the 2008 market crashes and just like comes crumbling down. And I'm like the kid who just showed up to the party and everybody's running out the back door. And I was like, where's everybody going, And but it was actually really good timing, because I think if I would have gotten into real estate before that, I would have done something stupid. I would have done like the no-doc loans, the stated income, said I made a bunch of money, but I really didn't, and got a bunch of money from the banks, bought it, a bunch of speculative garbage real estate, and probably would have gotten my butt handed to me. But fortunately, I bought my first property in, I think it was April of 2009, after the market tanked, and just scoured the MLS, found the cheapest house on the entire MLS, and it was listed at $25,000 for a duplex in the hood of Charleston, South Carolina. And that was exciting because it was only $25,000. The only problem was nobody's giving $25,000 to a kid who's never done a deal before, who's 23 years old, and in the worst housing recession in the history of the country. So that was the hurdle. And I think a lot of people would be like, oh, you know what, nobody's going to give me money. And then they make a statement to themselves, and they just accept that statement. I think one of the things that I've always done is, instead of telling myself I couldn't do something or whatever, I would ask myself a question of, how can I do it? And I think when you ask yourself good, like progressive type questions like that, I think it leads you down a road of better questions and better answers. And I'm like, all right, well, how could I get $25,000? Well, I could talk to my friends. Well, they're all drunk at bars spending all their money, or I could go to my family. They know me from, toilet papering houses in high school and getting drunk in college. They're not going to give me any money. So where can I get money? And I'm thinking, I was like, I look at my wallet, and I have a credit card, right? And MasterCard was giving me $3,000 at the time, essentially on my credit card limit. So I was like, maybe I'll just call up MasterCard and see if they'll give me a bigger limit. And so I called them up, and I said, hey, will you give me an increase? I'm about to make a big purchase. I need you to increase the limit on my card. And the lady on the other line is like, yeah. I mean, you've been a great customer since you signed up last year or whatever. And how much of an increase do you need? And I was like, $100,000.
I've done that. I know exactly what you did.
and she laughed in my face, and she's like, well, you've been a great customer for about 15 months, but not enough to
not
give
that
you
great.
Yeah. And I was like, well, how much can you give me? She's like, $15,000. I was like, all right, yeah.
Deal.
That's cool too. So I got, I got $15,000 access to money, and I had a couple thousand, probably $4,000 or $5,000 saved up from New York. And so I make the offer on the property, and you got to go in low, right? Like I went in at $12,000. They came back at $20,000. I went up to $14,000, which was like my maximum allowable, because that's all the money I had access to. And they ended up accepting it. So I bought it with a balance transfer check on my credit card. I physically did all the work to it. It took me about 60, 75 days in order to go through that whole process, to paint and change out the flooring. I'm Google searching and YouTubing videos on how to change carpet out and fixtures and this stuff. And literally paying my buddies in beer and pizza kind of a thing in order to help me out on this. And turn around, and I host an open house, had a bunch of the neighbors come out, put out bandit signs and flyers. And the neighbors came out, and one of the neighbors made me an offer for $33,000. I was all in for about $19,000. So after closing costs, I netted about a little over $13,000 on that deal. And I was like, dude, I'm a punk 23-year-old kid. I don't know what the hell I'm doing. I just made money. It's the worst housing recession ever. Like obviously,
Yeah.
let's figure this whole thing out. Let's go do it again. So I did it again, got heavy into wholesaling. And then, I think as you're going out and you build an expertise in something, you start meeting other people who see and respect you for that expertise. And they knew that I could find a good deal. They knew that I had a good work ethic. And I started meeting people who said, hey, Tim, you can go find the deals. You can operate those deals. How about I bring the money and we'll figure out some sort of a split? And that's how I got my first private money lenders was, we essentially did like a 50-50 split on the first handful of deals that I did, my first handful of rentals. And I did all the work. And then after about 12 months, I refinanced, paid them back, paid them off. And then I held on to the properties myself. And that was the start of getting my portfolio built up.
Man, that is a crazy story, and very similar to me with the credit card thing. I've told my story many times. I maxed out my credit cards for $50,000, and I don't tell people the part that you just said where I had to call them up. I didn't have that much credit yet. I called them up too, and I was like, hey, can I get an increase? And they're like, okay, like how much do you want? And I literally same deal. I'm like, I want $100,000, and they didn't laugh at me, but they're like, we'll present it and we'll get back to you. And then I ended up just getting the max I could. And same deal. I took a balance transfer check, and that was my down payment with the hard money loan. Unfortunately, in Vegas, we didn't have $12,000 properties.
Yeah. Well, you got started investing in what, 15?
Yeah, 15.
Yeah. So like this was 2009.
Yeah.
And just it was a different
Everything.
market. It was
Well-
like everything was on the market. Whatever you wanted to buy, go and make whatever offer you want. You couldn't insult people with your offer.
Oh, yeah. Well, I became a realtor in 2010. And in Vegas, man, I just remember the MLS had just choose whatever you wanted.
Mm-hmm.
They're begging to give you their property. Mm-hmm. And we would make such low offers for my clients. And what really got me mad about clients was that, in Vegas at the time, there'd be like a $80,000, like 2008 build house. Like this house just got built and the guy got foreclosed on 2 years later. And, it's like $80,000. And the people, my clients are like, man, I don't know. I think it's going to go further. I'm like, do you know what it costs to build this thing? Like, it's not going down. Even if it goes to 70, what are you going to do? Like, why are we even arguing about this?
Yep.
And they wouldn't buy, and that frustrated me, which led me down to the path of investing. But that same house from 2010 today is worth $400,000.
Exactly.
Crazy.
And that's the thing, man. Like one of the things that I've noticed is everybody wanted like the best deal, and they got really greedy on the buy side when the market was like that. And like one of the things that's resonated with me today is, dude, you don't try to like. You just go and do good deals. You're a baseball guy, right? Like you go to the plate, man. It's not home runs and grand slams that win baseball games. It's base hits.
Yeah.
The most base hits. Like just if it's
Keep
a
getting
good
on base.
deal,
Yep.
you just keep on getting on base, man. You just have base hit after base hit after base, and all of a sudden one turns into a double or a triple or a home run. But like, dude, swing the bat at good deals. Just do good deals, and eventually some of them will pop. And all of a sudden, man, like you look up in a couple of years, and you're like, damn, I have a really big portfolio of a bunch of good deals, right? They're not all grand slams, but they're good deals. They're all money makers. They all cash flow, and some of them are great deals. So it's just one of those things. Like if you come across a good deal, you should do the good deal.
Right. And there's always a way to do the good deal.
For sure.
Money's never the issue. Like if you've got a deal, somebody will fund it. So, going into that, you get this this private money lender, your first guy, and you guys are doing these rentals 50-50. You had developed your skills in finding good deals and, renovating them. How does it turn from going this single family duplex, small deal type stuff to these big deals that you now do?
Yeah, man. I mean, that's a great question. My story takes a little bit of a turn. So for like 2 years, I just built up a small portfolio. I had about 10 units, and I was like 25 years old in 2010. And I'm like, I got 10 units, and my residual income was more than what my monthly expenses were. Now I was physically managing it, so I was still, it wasn't passive, but it was residual. And so like I think I got this figured out. Like everything I touch turned to gold, and all of a sudden I go and buy a Mercedes, and then I go on the expensive trips, and I join the private clubs, and like, dude, and then I started chasing other shiny objects, and I took my eye off the ball. and I, pursued different network marketing opportunities and like different other types of businesses. And I actually ended up selling 9 of the 10 houses in order to focus on these new shinier objects. And dude, I went totally broke by 2012.
Wow.
So by the end of 2012, dude, I was buying gas with the coins out of the cup holder of my car. I was paying for like, dude, I would save money. I'd go to Subway, and go and buy a foot-long sub and put as many toppings on it as possible. I eat half of it for lunch, half of it for dinner, and then I wouldn't eat again until the next day. So like, I was intermittent fasting before it was cool to intermittent fast, right? They called it just being broke before.
Yeah,
right?
the poor man's reason for intermittent fasting.
Now it's cool, right? So
yeah,
it wasn't cool back then when you just couldn't eat, right? It's cool when you have the options, but anyways. So I ended up, what saved me out of that spot was I ended up selling my primary home. Real estate saved my ass, essentially. So I sold my home down in Charleston. That was the last property I owned down there. And I had enough equity built up in that property where I was able to take about $50,000, pay down some credit cards, pay off some debts. And then I moved back to Cleveland, Ohio, and moved back in with my parents at 27 years old. And so then I ended up moving into it swallowed my pride and moved into a family house that was owned by my wife's grandparents, actually. That was like 900 square feet, 3-bed, 1-bath, little bungalow house in this neighborhood. And just it was a very humbling experience, but I was very just open about where I was. And so I just needed to get my feet back underneath me. I knew that I needed to get back into real estate. And as I got back into real estate, there were some people that reached out to me and said, hey, we got into these other businesses because we wanted to get in real estate. What if we put up some money with you? And they put up some cash. And we did a lot of different kinds of deals up in Cleveland. We did like some high-end flips, low-end flips. This is like 2012, 2013 now. And then I bought like some single-family rentals. And then this 8-unit apartment building came across my desk. And it was a good deal, right? I bought it super cheap. I had to put some money into it. We created appreciation. And then I started flipping these single family rentals, and I started flipping these small multifamily deals. And I liked that aspect because if it didn't sell, I didn't care. Like I wasn't a very good flipper. I wasn't very good at like the detail and the customization and picking out the different finishes and all that stuff. And I hated the emotional aspect of flipping. Like somebody brings their spouse in and their spouse doesn't like the backsplash, and all of a sudden they walk from the house. And I'm like, dude, I like the investment side because it was just all about cash flow. It was numbers, and that's all that mattered. And if it didn't sell, I didn't care because I still had enough cash flow that covered my holding costs, covered my operating expenses, and put some money in my pocket, and then I could wait for the better offer. So I stopped like the high-end flips, but again, I just wasn't good at it. I know people who make a ton of money in that. They're just better at it than I am. It didn't match up with my skill set. And then I focused on this, and then I really just liked the scale of the apartments. So I stopped doing the single family. I just started looking for small multifamily. And I think there's really 2 ways to get into big multifamily deals. One is organically growing, like the way that I did. I bought an 8-unit, then another 8-unit, then a 15-unit, then a 23, then a 31. And I just organically had a couple hundred, or like 100, 140 units, and I bought an 80-unit, right? And then I bought a 60 and another 140 units. And all of a sudden, you're doubling your portfolio every time, because in order to qualify for 100 unit, you have to have 100 units with the bank. And so it allowed me to just keep on doubling and doubling and doubling as I grew my portfolio. And that's a good way to organically grow. Another way that you could do it that I didn't even know existed is you could link arms with somebody who already has a big portfolio. And you can go and source those deals, or you can raise money for them. You can bring the deal, you can bring the money. They can bring their balance sheet, their ability to qualify for the loan, and their experience in operating that big deal, and you can get a little piece of the pie. And I see a lot of people like, oh no, I want 100% of the deal myself. Dude, it's not about this deal. It's about, what does this one deal, you might only have 5% of it. What does it set you up for over the next 10 deals, over the next 50 deals, right? Like, how many deals can you do because of what this deal does for you and for your balance sheet?
Right. No, and I totally agree with you, man. Like, there are so many people that never do deals, period, because they're afraid to give up either equity or control or whatever. And, I tell our students all the time, I'm like, look, if you're not having the success you want to have, you're probably just one person away from success. You're not like one skill. Like, developing skills is hard, man. But if you already can have somebody that has the skills and the experience or the money or the deal flow, like whatever it is, you're usually just one person away from really just going crazy. And, I even look at my career. I've done well flipping houses and wholesaling, and I've just been slowly growing my rental portfolio like you talked about. But you actually challenged me because I had a goal this year. I said, you know what, I'm going to buy 50 units, probably single family, a mix of smaller multifamily. And you posted on my I think it was on Instagram. You were like, dude, if you don't buy at least 500 this year, like you're slacking. I was like, dude, what do you mean by that? Like 50 is a lot. Like, how am I going to get 500? And you're like, you need to start a fund with your social media following. You can definitely do it. And I was like, all right, like, tell me more. And then, you linked me up with your lawyer, your team, and, we're pretty much, by the time this episode launches, we might be in full force.
Yep.
And, I'm excited for that because, number one, if I didn't meet you, I wouldn't be going down this path of going after these big deals and starting the fund. It just would not have happened. It wasn't even on my radar this year. But number two, I know that I also have you to lean on, like whether, like you just said, we're going to do deals together. We might fund your deal or we might sell you a deal or, there's so many ways to work together in real estate. So I totally agree with you that it's just find a way to link up with somebody to do a deal.
Think about how young both of us are. Like, I'm 35. How old are you? You're 30?
32.
32? Like everybody in the big commercial game is 60 to 70 years old.
Yeah.
Right? Like, we are coming in and we are stirring up the industry, doing things in a little bit different of a way, a little bit newer of a way, sourcing deals differently, structuring deals differently, raising money a little bit differently, still SEC inside the lines, 100% compliant. But, like, dude, can you imagine putting our heads down and just, dude, I've been able to build my portfolio in 5 years. I was crappy at real estate for the first 7 or 8 years I was in it, trying to figure out. And then, like, I put my head down in 2015, and in the past 5.5 years, picked up almost 5,000 doors. And every year it compounds, right? Like, it just,
yeah.
And
You'll
so,
have
like,
10,000 probably by next year.
Yeah. So the idea is 10,000 in the next 18 to 24 months, right? And that's $1 billion, give or take, in portfolio value. I'm at about 426 million right now, and but guess what? Now I can go and qualify to take down a $300 million portfolio and double it overnight, right? Like, I just took down a $106 million deal last month.
Where's this at?
Houston, Texas.
Wow.
Yeah. So, like, I just remember dreaming about, I just want to get my portfolio to 100 million. Now we're taking it down in single deals. So, like, everybody overestimates what they can do maybe in 12 months, but everybody grossly underestimates what they can do in 3 to 5 years.
Yeah.
If you just you put your head down, you don't look left, you don't look right, you just do the work. Real estate's not an experiment. Real estate, works. Since the beginning of, civilization, wealth has been measured in land ownership. So it's not like a tech startup, right? It's not like a new concept that could go big or totally bust. It is like a proven industry that if you just stick with it and you buy real estate and you hold on to real estate, there's some certain principles you got to follow, and buy at a wholesale price and create appreciation. Don't speculate, buy for cash flow. Some of those kinds of things. If you stick to some of those core principles in investing, dude, you can't lose, right? Like, and now it's just a time game, and you have a ton of time on your side where, dude, by the time you're 60 years old, there's no doubt, no reason that you shouldn't have a multi-billion-dollar portfolio.
Yeah. And that's even mind-boggling to think about now. But, to see that you're already at almost $500,000.
Billion.
Or, sorry, $500 million, my bad. Yeah, you bought $100 million in one deal. So, at $500 million in just 5 years, man, and you and I, we were talking about 2015 because that's when I started flipping. That's when you, like, put your head back down and got focused again. I didn't expect to be where I'm at 5 years later, and I know you haven't either. Like, it's crazy. So
I don't even set my goals 20. Like, I used to have 20-year goals and stuff. I can't set goals more than 3 years out because they change and the opportunities change so much. And your skill sets that you develop and the talents and the associations and the connections and the resources, right? And the people that you connect with, there's just so many different opportunities. Like, that's a good thing, but it's also can be a lot of,
Let's talk
shiny
about that,
objects.
man. So
Here's a quick word from our sponsors. Are you looking to grow your real estate investing business? My company, Future Flipper, can help. We've taught hundreds of people all over the country how to flip, wholesale, and buy rental properties. And it doesn't matter where you're at in your investing journey. Whether you're trying to get your first deal or scale your company, Future Flipper can help. We have courses, coaching, and events for all levels of investors. So if you want to take the next step, go to futureflipper.com and book a free consultation to see how we can best help you. Once again, that's futureflipper.com. One of the hardest parts about real estate investing is finding a good contractor. That's where Southwestern Custom Construction comes in. They've been doing remodels in Nevada and Arizona since 2006. As a fully licensed and bonded general contractor, they're able to help with any type of renovation, all the way from an entry-level fixer-upper to a custom luxury home. Southwestern Custom Construction specializes in working with investors. I've personally used them on many of my projects, so I know their team is legit. If you want to get a bid on a project, head over to customhomenow.com. Once again, that's customhomenow.com. Are you looking to find off-market real estate deals? One of the best tools my team uses is Batch Leads. With Batch Leads, you're able to pull data, manage lists, and send text messages. On top of that, you can get nationwide access to the MLS to get pictures and comps. My team has used Batch Leads to get some of our best deals, so I know it works. You want to start today? You can get half off your first month by going to batchleads.io and using the promo code Ryan. Once again, that's batchleads.io, promo code Ryan for half off your first month. Now, back to the show.
All right, we had to call a quick audible because they brought us some cookies.
Yeah.
But the president of the hotel, who you didn't know, brought you cookies. So that was cool. But
Dude, nobody gave me anything when I was broke, right? Like I never ever got any gifts when I was broke, and all of a sudden I could afford it, and people
what
give
they-
me free stuff all the time.
well, you know what they say
Makes
is
no
like
sense.
famous people and rich people don't pay for anything.
I know
It's weird.
it is weird.
So, anyways, I think there's two things you just said that are super important I want to touch on. Number one, just networking, and I'm going to give you my thoughts on that. And then number two, like the goals. So, one with networking, I truly believe that the majority of my success, like nothing can be like a bigger, like, what is the word I'm looking for? Just like people. Meeting the right person is what has given me the most success. Like, no doubt about it. It's not that like I just learned this skill or went to school. Like, I met the right person and they told me to do something or they inspired me, and that's what changed my path dramatically. Would you say that's the same for you?
I'd 100% say that. I think it's hard to say it's ever one thing. Like it's hard to say that opportunity might not have come to you if you didn't also have the skill sets. So it's hard to say that it's success happens when preparation meets opportunity, right? So like
Right.
you have to be prepared. You have to know what to do with that contact, how to turn that into an opportunity for yourself. And I think one of the things we talked about, me being bad at real estate for the first 7 years and getting pretty good, 5 years ago. I think one of the things that pivoted, one of the things that changed for me was that I understood what the revenue generating activities were in real estate. Before, I thought creating a website was making money, was doing real estate. I thought making business cards was doing real estate. I thought inspecting houses was doing real estate. Dude, that's not what drives revenue.
Just get deals.
What drives revenue is a handful of things. Finding deals,
Yep.
sourcing money, and either finding sellers, finding buyers for your deals, or if you're going to hold on to it, just refining your operations, right? So it's like sourcing opportunities, sourcing deals, sourcing money to take those deals down, and then whatever your exit strategy is, either selling the deals to buyers, so sourcing those buyers, or refining your operations and your operations team. Like, dude, that's all that matters. If you are not doing those things, you're too far away from the revenue line. You got to come back center and stay on the revenue line.
Yeah.
And so I've just focused and I've beat it into my team's head of, dude, do the revenue generating activities.
Yep.
And so we focused on those things. So we got really good at doing the action, right? Like doing the activity, like being good at the business side of things. And then what's kind of weird is like, and I heard Dan Gilbert, owner of the Cavs, owner of Quicken Loans. He said like, somebody asked him, hey, what's the highest return on your time? And he's like, it's actually things that I cannot quantify. It's being on podcasts. It's being on interviews. It's speaking at events. because all of a sudden it's those networking that you're talking about, right? Like he's successful in his business, but now it's reached a point where now it's all about just connecting with the right people because you check the box that you're successful in business. So I think there's a little bit of a dichotomy where you got to have a little bit of respect in the industry and a little bit of skill set in the industry, and that helps you really leverage into the relationships and knowing what to do with those relationships. So when I meet a new person, I'm thinking, hey, Ryan, what can we do together? How can we make millions of dollars together?
Yeah.
Well, you know how to go and raise, or you have this huge influence, you have a huge following. What if I helped you with my skill set go and raise capital and help you deploy that capital, get you into deals that you never would have gotten into before, makes my life easier because now I have access to more capital and I can go do more deals. And all of a sudden, a rising tide floats all boats, right? 1 + 1 = 3. We can do more stuff together. And so I think it's a little bit of both. You got to have a little bit of the skill set and know what to do with the relationship. And then once you understand that, dude, it's all about building relationships. It's all about the things that you can't quantify then.
Yeah. No, and I mean, I look at my life, it's the same way. You know, I had to build the skill set, flip a couple houses, have success. Once I had success, it gave me the ability to talk about it, you know, and build social media and all that stuff because I had success. Mm-hmm. Nobody would listen to me if I was just, you know, a bum not doing anything. And then from social media, now all the doors have been open to, you know, these famous celebrities and influencers and then other real estate investors, and like just the opportunities are endless now. Mm-hmm. And then it's like, man, we can mutually benefit each other in so many different ways. And like I can go meet a YouTuber or a podcaster who has no idea how to use real estate, mm-hmm. like, or invest, and they have money because they've mm-hmm. been successful. And it's like, oh man, we have the perfect way to help and add value. So it's fun. It's fun when you just start compounding over and over again. But the other thing you said was goals. So goals are interesting because I've always been told that too. Like, man, what's your 5-year plan? What's your 3-year plan and all this? And like, I can come up with one, but as you said, I think I'm severely underestimating what I'm capable of because mm-hmm. it's like, I don't even think my mind could wrap around like what's truly possible and what could happen. Like, so for me, I'm really just kind of focused on this year and just being in the moment. Because things are just so constantly changing. I did not think I'd be starting a fund this year, you know, and, mm-hmm. and on a mission to go buy hundreds of units. Mm-hmm. And then that drastically changed.
Yep.
So I think you got to, like, with goals, be adaptable too.
Well, I think you got to realize, yeah, for sure, 100%. I think that's a great point. And I think you got to realize that, dude, every day has a lot of opportunities, but there's only one best opportunity, right? Like, what is the highest and best opportunity that's presented to you that day, like of how you can use your time. And I think, you know, I see a lot of people, you know, we're both in the real estate education space and we're both in the real estate investing space. I see a lot of people who get into the education space, and dude, the reality is the education space is easier to make money than actually going out and doing the work sometimes, right? Like once you have become the authority in that space, it's easy to make a couple $1 million a year, dude. It's not difficult to do that. And all of a sudden, you don't have the liability and the headaches and all the nonsense of going out and actually doing deals. So I see why a lot of people become the guru instead of actually going out and doing deals. And then all of a sudden, but I don't think that's good for business either. Like you're still doing deals. That's really important in order for you to be seen as an authority in the space. I see a lot of these guys who just stop doing deals, right?
Yeah.
In the commercial space, what's exciting about the commercial side of things is like, I make a lot of money, dude. I make 7 figures in my education business, but I make 8 figures in wealth building and net worth building on an annual basis in buying more property, right? That deal I took down last month increased my net worth. Now it's not real cash, right? But it increased my net worth by $7.5 million on paper. And eventually I will realize that as true income, you know? So it's like,
and it'll be more than that.
Probably.
By the time you realize it.
Right. In 5 years, 10 years, whatever, it'll be probably 8 from that one deal. And that one deal gave me $3.5 million of depreciation this year alone.
So let's talk about this one deal, man. Where did it come from? Like, how did you get to this? I mean, I get how you got to the 100 million level. How'd you find this deal? Like, how did you structure it? Like, how much money did you have to raise? Everything.
So this one's a little bit. This one's different, right? I think Dude, I remember watching a guy named Dave Lindahl grow, and he was like on this tear to get to 7,000 doors or something like this. When I first got started in real estate, I was like, I can't even comprehend 7,000 doors, right? I think it's hard for people to comprehend 5,000 or 4,800 doors. Like, how do you get the first 100, right? How do you get the first 200 units? Is it okay if I kind of backtrack and kind of talk about that first? So like the way that I structure deals, I've seen your education on the Burr method, right? Like you've told people about the Burr method. The Burr method is buy, renovate, rent, refinance, rinse and repeat, right? So you buy a house and you're all into that house for, let's call it, I don't know, $150,000. It then appraises for $250,000. You get a 75% or 70% loan to value on it. So they give you $175,000. You take that $175,000, you pay yourself back, or you pay back your hard money lenders. You put a little bit of cash in your pocket, and then you have long-term debt on that rental property, and you hold on to it, and you let the tenant continue to pay rent. You make some cash flow on it, covers all your operating expenses, pays down your mortgage, and the property appreciates over time. It is a remarkable method and to build a lot of wealth on the single-family side. I'm a single-family guy. That's what the world that I come from. I've never taken a class on commercial real estate. So when I got involved in commercial and started getting into apartments, I just took the same methods, dude. The same methods to find off-market deals, the same methods on how I raised money and how I financed deals, and the same Burr method that I was doing on the single family. I just took it and started doing it with apartments. So the difference is you're adding a zero. And instead of a $250,000 house, I'm buying a $2.5 million building that I'm all into for $1.5 million. And then I turn around, I refinance it. They give me a new loan at $1.75 million. I pay back my acquisition financing. I pay back my private money lenders. And here's what that looks like. If I'm all into something for $1.5 million, let's say, the acquisition financing, like the bank financing, the construction loan, they'll give me about 80% of that money. So they'll give me about $1.2 million of the 1.5. And then I have to go and raise $300,000. That $300,000 can come from one person who brings $300,000, or it could come from six people that bring $50,000 apiece. That's called syndicating. So when you hear about people syndicating real estate, that's what they're talking about. They're pooling other people's money together, and you're creating a security. You got to stay SEC compliant. You're doing the right thing by putting all the right documents together and all that. And dude, it not only covers the investor's ass, but it also covers your ass in the whole fundraising side. So I'll go get a bank loan for 1.2. I'll raise 1.3 month. I'm sorry. I get a bank loan for 1.2. I'll raise 300,000 from investors, and with that 1.5 million total, I'll buy and renovate the apartment building. That process can take anywhere from 12 to 36 months on average, depending on the size of the building. Maybe even sometimes less, depending on how stable or unstable it was. And then the idea is, let's call it 24 months later, I go back to the bank, a new bank, probably Fannie Mae, Freddie Mac. You can go to like insurance companies. You can go to CMBS, commercial mortgage-backed securities, and you can go get a loan that's a non-recourse loan, fixed interest rate, 30-year amortization schedule, 25-year amortization schedule with like a 10-year balloon payment that's due. And you can go and put long-term debt in place on this asset. So now I'm all into it for 1.5. It then is worth 2.5 million 2 years later. They give me a 70% loan on it. That's 1.75 million. With that 1.75, 1.2 goes back to the bank, 300 goes back to the investors, and then there's $250,000 of non-taxable refinance proceeds that I carve up between me, my joint venture partners, and any sort of equity investors, passive lenders that were in that deal. And then we've taken all of our chips off the table. Right now it's just house money in play. It's long-term debt. All of our investors are paid back. Now we can hold on to the property for as long as we want, right? And then future Ryan can make a decision on what to do with that property 10 years down the road based on where the market is. So that's the Burr method with apartments is essentially my entire business model. And if I can recycle my investor capital every 24 months, dude, then I can just roll you into another deal. And all of a sudden over the next 5 years, 10 years, we're in 5 different deals together. And you've made a good fixed return on your money, and you get these pops of refinance proceeds, and you get residual income from the cash flows, and you get depreciation to offset those cash flows. And then in the future, we sell the property, you get more big pops. Like, dude, it's a pretty powerful method on building a lot of wealth. And now it's just how many times can you do it, right? Like, Just double down. Just keep on doing it. Keep on doing it. And it's turned into something that's almost like boring for us because we've done it so many times. But the most successful business owners that I know have boring ass businesses. It's just repetitive. They can do it in their sleep, and it's just, but it prints cash, right? Like once you get to a point in your business where it's just boring, that's when you know, like that's when really the profits start rolling in a big way. So I see a lot of people who like jump ship and they like, it's boring. I want to go do something else. No, dude, double down, keep your head down, and just work harder because then it just starts printing cash out. So, yeah, man, it's but that's my business model, right? And so I just did that with this big apartment building. We're all into it for about $77 million. And or we will be all into it for about $77 million, and it'll be worth about $106 million when it's all said and done. And so we'll go get an 80% loan to value loan on it in probably 3 to 4 years. It's a big deal. It's like 600 doors. So we'll go get a new loan on it at that time, pay back our acquisition financing, pay back our private money lenders, and then we just have house money in play. So it's the exact same thing, just at a much larger scale.
Right. Where'd you find the deal?
So it came from a broker, and I think this comes with some experience. A lot of people came in and looked at the deal and just looked at the financials the way that they were. And if you just looked at it, because it's 550 doors right now, if you just look at it like that, it's a marginal deal, right? It's like, man, you be all in for 77, it's worth, I don't know, 82 or something. What we saw, like my joint venture partner is a construction guy, and he's like, dude, there's a disproportionate number of 3-bedroom units at the property. There's not that many people who live in apartments that need 3 bedrooms, right?
That's
like
rare.
It just doesn't happen.
Right.
And there were like, I don't know, out of 550 doors, there were like less than 50 units that were 1 bedrooms, which is really the highest bang for your buck in apartments. And 2 bedrooms, there was, I don't know, 200, and then there were like 300 or something. Of the 3 bedrooms. And
That's
we're like,
so odd.
Dude, really odd. And so he's like, dude, we could take about 30% of the 3 bedrooms. So it's like 100 units or something. And we're essentially, the way that they're laid out, we realize we can take a 3-bedroom apartment, add another kitchen, throw a wall in, and turn it into 2 1-bedroom apartments.
Right. You can double your units.
So yeah, so we added like another 100 doors. It's like 650 doors or something. By doing that, and it makes it a lot more proportionate of 1 bedrooms, 2 bedrooms, and 3 bedrooms, and we get so much more pop on the 1 bedrooms that all of a sudden, dude, you start running numbers on it, and you realize, damn, the value now goes from $83 million stabilized to $106 million stabilized, all because we put another couple million bucks in.
Yeah, it's a couple $1,000,000 to get 20 million.
Exactly.
Yeah.
And so the return on investment was there, and we're like, bam, this
because nobody else saw the opportunity, and that's crazy. I feel embarrassed even talking about this, but so I was looking at a 30 unit, which is not 600 units, but they had this huge like bingo hall, because it's a senior kind of community. I'm sitting here looking at this bingo hall that's just full of junk. No one's using it. I'm like, man, this could easily be another 10 units.
Yeah.
And nobody else is seeing this. Like, you don't need a bingo hall with 30 units. Like, so that's a great tip just at any level. If you can just add units anywhere, maybe it's common space or like you just did, making units smaller because you don't need 3 bedrooms in apartments. That's a great tip. So,
or you bring in like one of the things that we've done in several of our buildings is like we make like I would take that bingo hall and try not to like it's a lot of investment to start throwing in plumbing and all that kind of stuff in an area that doesn't have it already. So like, what if you brought in just dividers? You turned it into like one of the big things that's going on right now with COVID is everybody's working from home. But then they're also realizing, like, I need to get the hell out of the house a little bit because the kids are tugging at my pants. I can't really get the work done. My wife doesn't really think I'm working just because I'm working from home. You know what I mean? And so they want something like a micro office to go and throw their stuff down, meet a client, whatever, because they don't want to meet people at their own house. So, like, a space that we found is we're having some success with is like these micro offices that aren't like as expensive as WeWork, but kind of a WeWork type concept, just basic though, little vanilla box.
Yeah.
Like I would take a look at that bingo hall and say, hey, could we just throw some walls up, throw some desk space in, essentially rent it out like almost like desk space at a real estate brokerage of a couple $100 a month for somebody to just be able to go in, have access to Wi-Fi, be able to meet with clients in a conference room, and just get some work done to get out of the house a little bit, minimal expense, and all of a sudden, like, you're generating additional revenue. So, like, we're always looking at, in the commercial world, it's not like residential where you say, hey, this house is 3-bedroom, 2-bath, and sold for $250,000. My house is 3-bedroom, 2.5-bath, a little bit more square footage, and it's a comparable method, right? Like, that's how you value property in the residential world. In commercial, it's all based on the income approach, which is, what is the income minus the expenses equals the net operating income, and then it's a multiple of that NOI. That's what the cap rate is. So when you hear cap rate, that's the multiple that the net operating income is valued at in that marketplace. And so it's very predictable what you can, what a property's worth, and it's very predictable of what actually increases the value of the property. Because if it doesn't increase the income, or if it doesn't decrease the expenses, don't do it. Like, there's no point in doing it, right? If you can't do one of those two things, those are the two things that directly affect the net operating income of a property. Increasing the income, decreasing the expenses. If you're not doing one of those two things, you just don't do it in commercial real estate.
Right. And that's one thing I always tell people too with any business. It's like, at the end of the day, whether you make more money or you save more money, the result is the same. Mm-hmm. You know, making $5 is the same as saving $5 at the end of the day. And so, like...
And it directly affects the net operating income just as much.
Yeah, it's the same thing.
Yeah.
So, and that's what's cool about commercial real estate is it's just strictly, like you said, it's a business, essentially, is the way they look at it.
Exactly.
And that makes it easy. Like, you got into it for the numbers. Mm-hmm. And you didn't have to worry about, like, how pretty it is. It's just, hey, what does it make?
Completely non-emotional.
Yep.
It's all dollars and decimals.
Yeah. So tell me a little bit about this. You know, I know what it is, but I think some of our listeners would like to know, like, if you're structuring a deal, you know, you've got these GPs and these LPs and stuff. I mean, you just talked about cap rate. Like, who are these people in the deal?
Yeah, good question, man. So GPs are general partners. These are really the operators of the project. So it's the people who are finding the deal, managing the deal, overseeing the construction, overseeing the property management, overseeing asset management, really involved in raising the money, signing on the loan. The general partners are the active operators in a deal. The LPs, the limited partners, are the ones who are passively investing in the project. So they say, hey, I love what you're doing, Ryan. I just don't want to do all that work, but I have money or I have access to money. Yep. Let me give it to you, and you put my money to work for me. So I give you money, and all of a sudden you pay me. You could structure it a million different ways. The way that we structure it is we pay a fixed return, typically in the 6 to 10% range, while their money's invested. And so while their money's invested, they're making a good return on their cash. And then when we refinance, they get all their money back. But then we keep them in equity. We give them a little bit of equity in the deal. We'll carve up, let's call it 25% of the equity for the equity, the limited partners, the equity investors is another name for them. And even after their money's paid back, we'll give them about 25% of the equity in the deal. So now it does a couple different things.
There's no money in the deal now, too.
They have no money in the deal. They earned a great return. And then they're actually able to build wealth, right? Like, typically a lot of private money lenders, there's two opportunities. One is the debt loan of, hey, I lend you money, you pay me 10%, and when I get my money back, it's game over. I got to go find somewhere else to go and lend my money in order to make money again. The other one is an equity investor where I give you the money, it sits in the deal. If the deal performs, I make a return. If it doesn't perform, I don't make a return. It could sit there for 5 years, 10 years, maybe longer, and hopefully down the road you get some. But you have equity upside, but you don't have predictable cash flow. What we've been able to do is create kind of a hybrid structure where we pay a fixed return while the money's invested. Me and the team go in and we force appreciation. We don't speculate or hope on it. We will create it through putting sweat equity into the deal. And then we can very predictably refinance them out within 2 to 3 years, get them all their money back, and then they maintain equity in the deal, right? So like they might get a fixed return during that time, but then they get cash flows, then they get depreciation, then they get refinance proceeds, they get equity in the deal, so that continues to grow as we pay down the principal and as the property appreciates.
Yeah, I think the thing that's really attractive with your business model is it doesn't really matter what happens with the market. Like, I mean, like, what's the worst case in 2 years? Okay, they say, oh, it's not worth as much now because the market tanked, but you're still cash flowing. Like that's your worst case is you just cash flow. You don't get the refinance that you thought you were going to get, but you're just cash flowing instead.
Like you don't lose the value, right? Like maybe if you refinance and you pull out, you take a higher loan to value, you pull out a bunch of refi proceeds. That's great. You have the refi proceeds, but that means you have less cash flow because you took a higher loan to value.
Right.
Make sense?
Right.
If the market shifts and interest, like values of real estate are based on values of commercial property are based on cap rate. Cap rate is directly influenced by interest rates. So if interest rates go up, that means cap rates go up. Cap rate's another word for return on investment. So if you want to buy something at a 5% cap rate in Las Vegas and it nets $50,000 a year, you want a 5% return on your investment, you would pay $1 million for that. Does that make sense?
Yeah.
So you pay $1 million, it nets 50,000, that's a 5% cap rate. So as the cap rate increases, the value comes down. So if you want a 10% cap rate, the market goes to 10 cap, then the most you would pay for that is $500,000. Does that make sense?
Yeah.
So it's an inverse relationship. As the cap rate number goes up, the value comes down because it's a multiple kind of a thing. Think of cap rate as return on investment. And so when interest rates go up, cap rates go in line with that because nobody's going to buy something at a 5% return if interest rates are 7%, right? Like it doesn't make sense. You'd lose money on the debt service on a monthly basis. So values in real estate in commercial real estate are very much aligned with wherever the interest rates are. So it's very predictable of what could happen. But the idea is even if interest rates go up and the values come down and you can't take out those refinance proceeds, that just means you don't get that upfront cash, but you have a lower loan to value, so you have more cash flow on an ongoing basis.
Right.
So you don't lose the value, it's just coming in different ways. It's either in refi proceeds or it's in cash flow in the property.
Right.
But the value is always going to be there.
Right.
And worst case scenario, dude, you ride out the storm for another 3, 4, 5 years and wait for interest rates to drop again, and you wait for values to come back up, and then you can refinance, then you can sell, then you can cash out in a number of different ways.
Yeah. So with cap rate, the way I've always understood it is that, everything you said as far as determining value, but also too, just with different markets and different classes of property. So, wouldn't it be in a little bit riskier areas? They want a higher cap rate, and these A-class neighborhoods, they're taking lower cap rates.
Yeah. So in more of a primary market, like a Las Vegas, like a Dallas, like a Columbus, Ohio, or DC, those are seen as primary markets, very stable, very, very safe markets. And, if you're talking about return on investment, you're talking about like what does it, the greater the return on investment is perceived as more risky. The lower the return on investment is perceived as safer. So if you're going in from a standpoint of a primary market, it's seen as safer. So it's a lower interest rate, which means it's a lower cap rate, which means there's more value there. If you get into a secondary market like a Cleveland or a Charleston, South Carolina, or a Oklahoma City or different types of markets like that, it's more of a secondary market. It might be a military town. It might be heavy in one business. It could be with one employer. So you have to pay attention to some of those things, and the lenders do, and it's perceived as a little bit more risky. So the interest rate might be a little bit higher, which means the cap rate
needs to be higher.
Which needs to be higher. But sellers expect that, so it's not going to sell as expensive as something in New York City or San Diego or Las Vegas, Nevada.
Right. What's your preferred, I guess, markets that you're going after? Are you going after these A+? Are you going after C, B? Like, what are you going after?
Yeah, I think that's a great question. I think it depends on where you are in your business. Like when I first got started, my mortgage broker kept on telling me, he's like, dude, just build the balance sheet, right? Like you got to build the balance sheet. So I took down small deals. I took down big deals. I took down medium-sized deals. I would buy in C-class neighborhoods. I didn't really get into the hood or anything like that. Not when I started buying apartments. I did that in the single-family side. But I'd buy in C-class. I'd buy in B-class. I didn't really get into A-class because I don't come from money, dude. I had to create value. I had to create appreciation. So I bought the stuff that needed more work, that was in a little bit more management intensive parts of town, the C-class kind of areas. and I built my balance sheet that way. Now, where I am today, I'm actually selling about 2,000 of my doors, taking a step back so that way I can make leaps forward, right? Like those, probably 1,500 doors are in like C+, B-, just a little bit more management intensive. Maybe there are some of my smaller buildings under 100 units. So I'm selling a lot of that stuff and just trying to like, lean down, right? I'm trying to trim off a little bit of the things that take a lot of calories, brain calories, in order to manage it up. Yeah.
Right. I know all about that.
Yeah. And so I'm getting that stuff out of my portfolio because my team not having to deal with that stuff is going to allow us to make leaps forward in our business, and we'll be able to pick up thousands and thousands of doors in a very short amount of time. So I think it depends on where you are in business. If you're new, early on, build the balance sheet. Building the balance sheet is the most important thing you should do.
Like we said at the beginning, get good deals.
Just get good deals, right? It doesn't have to be a home run. It needs to be a good deal. Build the balance sheet, and then as you will find that the C-class stuff looks good on paper, but dude, it's not. If you own it for a long time, you realize how management intensive it is and the amount of turnover and all the others. Like it's not like the B class, middle of the road stuff is what I love. I love the workforce housing in blue collar areas, not luxury, but not C class. Right in the middle, right down the middle of the plate, where it's very hardworking people. They have enough disposable income where if they get a flat tire, it doesn't derail their finances. They have respect for the property, they have respect for their neighbors, and they don't move, right? Like they're not transient like a lot of the C-class tenants are. You will find that if you buy properties, your biggest expense is going to be that turnover, right? Tenant turnover. If you can reduce tenant turnover, dude, that is where it's at. So the more you can reduce turnover, the higher your return is going to be. And so that's why I stick to like B class, B+, A- kind of areas, workforce housing. I don't get into luxury because when the market shifts, all those luxury renters move into more of a workforce housing. When the market's good, everybody can afford workforce housing. It's very insulated from market shifts.
So what's going to happen to all Uncle G's luxury apartments, man?
Well, here's the thing. He has FU money, right? He has access to so much capital and so much cheap capital that he doesn't need to return it to his investors. So he's able and willing to go and buy something at a 4% cap rate, something that I would never buy, but he's got access to different kind of money. And I will say this, I respect a lot of what he's done from a standpoint of like sales and marketing and influence and personal finance and that kind of stuff. I don't like his business model for me and for people who are getting started, but I understand why he does it. The reason he does it is because, dude, you can't lose money on 400 units in Boca Raton that's on the friggin' water, right? Like it's not going to make you rich, but it will preserve wealth. It's like a bond. It's like, hey, 3 to 4% annually forever, and like you can preserve wealth there. He has access to a lot of money, and the reality is he's in the fee game also. Like he goes in and he takes an acquisition fee, he takes sponsorship fees, asset management fees. There's a lot of fees that he takes off the front end that he, it's like boiler room, right? Like everybody's else making money on paper. He's taking home cold hard cash.
He's actually making money.
Right. He's pulling it off and he's making a lot of money, but he's also the sponsor on the deal. So he can pull off a ton of fees and still have a ton of depreciation on these things that offsets all those fees. So dude, he's not paying taxes on a lot of, like there's a lot of benefits I understand why he's doing that because he has so much influence, so many people willing to throw money at him. It's not the business model that I prefer or I would advise people to move on, but I understand why.
When you have that much money, even if you're a billionaire trying to go invest,
you just need to put it somewhere.
Yeah, you got to put it somewhere. There's not enough great deals to put it on. You just got to put it somewhere. So yeah, man, dude, we got to actually go bowling after this. So we got to
that's right.
We got to cut this a little short, but this has been so much value, dude, and. If you guys have liked what Tim's been saying, definitely comment below. We'll have to do another one with him, and if I perform well enough tomorrow, he might invite me back to the next event speaking, so we could reconvene again. But Tim, dude,
I'll come out to yours.
Yeah,
I know you're working on some stuff too. So
we got a big event coming.
Dude. We're just getting started, man.
Yeah.
That's what I love about this.
Yeah,
like
this post. Well, I guess we're still technically in the pandemic, but we can go out and do stuff now. So
for sure,
it's cool. But if people want to learn multifamily, we were talking about education, or even potentially invest with you. How do they find you?
Yeah, I mean, social media is always the best, right? Like, connect with me on Facebook, Instagram. That's where I'm most active. I also have a
What are your handles?
at Tim Bratz is my Instagram. At Tim Bratz is TikTok. And then TL Bratz is the Facebook one. So I'm real active on all those. I have a YouTube channel called Legacy Wealth, and we're just really starting to ramp that up, trying to put out a lot of value on there, just like you. You know, I've got a ton of value from you, man, and a ton of insights from you on building that stuff. So
Yeah, man.
appreciate that. And yeah, I have Commercial Empire, which is my 2-day boot camp on how to go out and buy apartments, how we source deals off market, direct to seller. How we raise money, how we structure it, how we operate it. All that stuff is done at commercialempire.com. So, dude, appreciate you, man. Thank you so much for having me. Love what you have going on. I appreciate and respect you from a real estate professional and influencer standpoint. And dude, I'm excited for what the future holds, man. I know you're just getting started, so you got some big stuff ahead of you.
I'm trying, man. I'm trying to be like you, dude. Trying to have, not $500,000, but $500 million worth of real estate. I feel like an idiot for saying that, but yeah, dude. So we'll link to your stuff below so everybody can go access it. And guys, hit up Tim, go give him a follow. He is crushing it, and I'm excited to be at this event and to continue to learn from you. And I know that with my fund, we're going to be doing some deals with you here in the near future, and it's going to be exciting stuff, man. So appreciate you coming on.
Just getting started, bro.
All right, guys. Thanks for listening. Take care.
Thanks for watching the Ryan Pineda Show. If you want to work with me, head over to ryanpineda.com. You can find my courses, coaching programs, and upcoming events. We also have free resources you can download, so head over to ryanpineda.com.